and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. 6 months of the year are already over, and we've spent the last 6 months, the last many years, of course, talking about the mutual funds that you should have, the trends that you should be wary of, the insurance that's really, really critical for your portfolio and your well-being. Well, today's show is slightly different because it's not about stock tips or even mutual fund or insurance-specific product tips. It's more holistic in nature. Today's show is about how we need to look at our wealth creation journey perhaps differently, sometimes take a step back, look at whether we are doing things right, fix whatever we are doing wrong, and take a wider view of our overall financial journey. And helping us do that is someone who's got several decades of experience in the financial landscape, in the investing landscape, and she's an author also, and she's watched stock picking, money, personal finance up close and personal. Yes, let me welcome on the show Devina Mehra, founder, chairperson and MD at First Global. Devina, thank you very much for taking out the time. I know this is your first Let's Talk Money. We always grill Devina on whether this sector is good or not. What do you do with, stock A versus stock B? But I promised you a different conversation. Thank you so much for joining in for it.
Thank you for having me, Surabhi. Pleasure to be here.
So, let's look at things a little more holistically in your own journey, because you're someone who was working in the big bad world of finance with, I think, a US bank. And then you decided to go your own way to look at, whether it's portfolio management, wealth management separately. So why don't I start with an open floor kind of a question to understand what you have learned along the way?
Oh, that's far too many things, because it was an evolution. When I started this business in 1993, even stock research did not exist as a career. I mean, no company had an investor relations department. Such a thing did not exist. So right from there, and we did not have, you have a course in IIM Ahmedabad on securities research, because that option did not exist as a career. So it has been a journey, and of course you learn many things which are there in the textbooks. Also, you really understand only when you live through it. For example, asset allocation accounts for 85% of your return is there on page 1 of every investment book. But
you're still looking for the stock.
Yeah, you're still looking. You start with looking for the multi-baggers till you come full circle and find out that yes, what was being said made sense.
Yeah, so let me ask you, Abhin, and in your decades of observing the market, observing different types of investors, big, medium, small, how has the Indian investor changed? And I mean not so much from the point of view of the wealthiest, bulge bracket, family offices, but more from, say, the mass affluent. What are the changes you've noticed?
So in the beginning, of course, not that many people invested in the markets to start with. So that has become, you can say, democratized over time, and especially after COVID, which has both pluses and minuses. And people, and very often when people get into the market, they think there is some magic wand which will make them rich quickly, or they will have something where they can get the multi-baggers, or for that matter, which is even worse, that they will become these traders who make money. So that's how all these courses get sold off. And I recently wrote that anybody who has this magic wand where they know for certain what will be a multi-bagger, or for that matter a good trading strategy, why would they share it with you? If they can make 1% every day, that means they can have their money grow 7 times in a year. So they're not going to share it with you. And you can just do the calculation that 1 crore can become 20,000 crores in 5 years, and so on. And
I think that's already the first lesson that we have from this conversation, that don't fall prey to stuff that seems absolutely gold-plated. It probably isn't, right? That's probably lesson number 1 from this conversation. But on that's also perhaps a reflection of the essential need to grow wealth in a better way, in a faster way than what we've seen our grandparents do, or even our parents do. That time, I mean, there was less investing, it was more saving. It was all about a bank fixed deposit or the odd LIC policy, right? So now I think it's well understood that mutual funds are one of your very good friends. If you were to advise anyone to look at very holistic portfolio management or wealth creation, what's the starting point?
So the starting point is your asset allocation. And just as in Google Maps, you don't just put in your destination, you have to put the starting point. So first understand where your investments are. And investments, people, as soon as you say investments, they think it means stocks and mutual funds. But no, I mean, all those tax saving schemes that you invested in. So those are also investments. Some land you inherited from your grandparents, or apartment that you have booked, gold. If you hold some crypto or anything like that, everything is investment. So first look at all where you are invested, and against that you might have loans, housing loan, car loan. So look at the whole picture and then decide where do you want to be. So do a deliberate asset allocation, and if you do that sensibly, that is 80% of the way through. So sometimes people just freeze, saying only if I understand everything well, I don't know enough about stock markets, then I will start investing. So you don't have to wait for the then. You start with the basics, you get the broad allocation right, and start as quickly as possible. We've all seen those calculations that if you start saving at 25 versus 30, how much more you would have to save, or 35, 40. So start quickly. And one other thing, don't be at extreme ends of the risk spectrum. You spoke about savings. Yes, savings alone is not enough. So if you save a lakh a year and put it in a bank fixed deposit, you will have 75 lakhs after 30 years. If you are
that's scary.
Yeah, if you are in a multi-asset portfolio which gives you maybe 9.5% compounded, you will get to 1.7 crores. If you're a slightly more aggressive with more equity, maybe 12-13% compounding, you will be at 3 crores. So 75 lakhs and 3 crores. So that's the range. So even without taking excess risk. So be sensible about it. Don't be in a hurry to get rich quick. So that I will repeat. So there is no magic formula. Nobody has a magic formula for multi-baggers. Sometimes people ask me that you found HDFC Bank in 1996 or Amazon in 2001. So tell us, what is the next Amazon or HDFC Bank that I can buy for my child and forget for 20 years? So nobody has a crystal ball for 20 years. Nobody has ever had a crystal ball for 20 years. I mean, Warren Buffett says that in 75 years, maybe 10 of my decisions have made me all the money. So if he knew which 10 they were to start with, he would have put all his money there. Same with Rakesh Jhunjhunwala, same with anybody. So no one knows in advance what the trajectory would be. So no one knows which company will be a multi-bagger. So you have to take a sensible approach, and you have to manage risk very tightly, because investing is a loser's game. So that's
that's also a heavy headline, right? Investing is a loser's game. You just have to ensure that your winners are bigger than your losers.
You have to ensure that you play not to lose. So winners games and losers games, the difference is that and games change. So aviation once upon a time was a winner's game. When J.R.D. Tata was flying that Karachi-London flight, it was a complete adventure sport, that some part didn't work, he wound a wire into something and made it fly. Now, I mean, it's not a very great example to go presently, but the point is that the only way to fly an aircraft today is to go by the checklist and make no mistakes. So investing maybe, 50 years ago, when even getting a annual report, even 30 years ago, was not easy, and you could unearth gems which no one had heard of. But now that is not the case. Now information is available. You have to play that not to lose. Not to lose doesn't mean that you don't book losses. In fact, you have to book the small losses so that you don't take a big hit on your capital. That has to be the mantra. So if you don't lose, then you win, because then the compounding will take care of you. But if you are refusing to admit mistakes, and I mean, I say the best thing you can do for your portfolio if you're investing in stocks is, when you invest, tell yourself, I may be making a mistake, because I can guarantee you a significant portion of your investments, things will not go as you envisaged.
So be humble about it. Devina saying starting point is that you could be making a mistake. Just admit that, and then cut the losses in
so that you don't take a big hit, because percentages are not symmetrical. If you lose 1/3 of your capital, then your capital has to go up 50% for you to go to zero. If you halve it, then you have to double it. So it, like, down 50% means you have to be up 100%. That's how it goes.
Mistakes are costly. Make sure you cut your losses and cut those mistakes in time. But Devina, I want to take a step back. Actually, we're talking stocks and investing. I want to ask you about the difference in the DIY approach and the difference in letting it run through a professional fund manager, and then the headache is to pick the right fund manager as well. It's not easy, right?
Right.
Since COVID, because like you're saying, information has been widely available, And we have all these fintech apps. I mean, you can buy a stock perhaps as quickly as you swipe on your Instagram profile, right? It's become that easy in terms of the technicality, the access. Yeah, whatever you're browsing. I mean, in that same microsecond, you can be buying or selling a stock as well.
Right.
I mean, what's the advice you give to people when they ask you, what do you think, personally? Should full-time working people be managing their own stock portfolios?
Do a thought experiment. That's what I tell people. That let's say you want to invest yourself directly in the stock market, and then you are considering, let us say, half a dozen other funds or PMSs or whatever. So consider yourself also a fund manager. So you have these 5 or 6 fund managers, and you are fund manager number 7.
Wow, and you're competing with the best of the best in the country.
So you look at your entire track record. Don't pick and choose, and don't say that last year I found this multi-bagger. No, I mean, now in your DP account, look at everything that happened and look at what were your returns, what was the volatility, and then compare it with all the other 6 fund managers, and then see whether you are the very best. If you are not the very best, then you definitely should not be investing 100% of your investments directly. So that's of even your equity allocation directly. But I mean, this is an interesting thing to do. You want to do it, you want to learn it. So I mean, the only way to learn it is by doing. So if that is the case, allocate a small percentage to yourself, almost like play money, that okay, I will play with 10 or 20% of my corpus, and the rest I will give to professionals. Because it's difficult, as you said, that people have a day job, they cannot do this full time, and therefore, their results are unlikely to be as good as the professionals. And and always look at returns and risk volatility, both sides.
Yeah. Okay, fair enough. I think that gives us a good starting point. What we'll do is we'll take a quick break, come back after the break, and we'll get Devina's help to design the rough framework for a medium risk portfolio. We'll take some examples, we'll put certain thoughts in place in terms of the financial goals as well. Back with that in just a bit.
Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week Devina Mehra is helping us put some rules in place to that whole quest for creating long-term wealth. Devina, so now it's time to ask you for some advice. So I'm going to take an example. Say someone who's in their mid-30s, earning, will perhaps continue to earn for another 20 years and is looking at a holistic approach to portfolio creation. So what is the kind of looking at the market environment today, what is the kind of asset allocation, which markets, which asset classes, what's the proportion? What would you advise this medium risk mid-30s investor?
Okay, so first of all, of course, everybody's life circumstances are different, that how many kids you have, whether your parents are dependent on you, many of those factors come into play.
Absolutely.
But one thing when you're planning for 20, 25 years, which we haven't spoken about till now, is that look at global diversification. That is so important. I give the statistic all the time that when I started working, the dollar was 12 rupees. So it's been
I cannot. What? When you started working, $1 fetched 12 Indian rupees.
12 Indian rupees. So in the
86 something today.
Yeah, so in the course of less than a career, there's been a 90% depreciation. So when you are planning for 20, 25, 30 years hence, this is not something you can forget. So because that your rupee loses value over time. And very often, if anything, hard currency expenses have gone up since then. People study abroad, people's children study abroad. And often settle there. So I hear many times people say that after retirement we'll spend half the year there. So basically your hard currency expenses have been rising, and Indians still do too little global diversification, because when we were growing up there was no option to it. India did not have capital account convertibility. You could not invest in global markets. Now you can. So our grandmothers were right to buy gold, because at that time that was the only currency hedge. But now you have the whole world. Again, people think global diversification means that you buy a NASDAQ index, or you buy the 5 stocks you know the names of, or another 3 Chinese stocks you know the names of. That is not global diversification. Global means global because one golden thing in investing is that themes change. So no asset class, no geography, no sector does well forever. So it, US has done well last 12 years, but there was also, for example, 2003-4 to about 2007, US, and it wasn't coming off a high, it was already in the doldrums after the tech crash, still it continued to lag, and that was a golden period for emerging markets. India went up 6 times, whole emerging market index went up 3.5, 4 times. So you have to have the whole globe as the, so that's why, I mean, for me it's a cause. So that's why, I mean, we have a whole, all investing across all geographies, all asset product that starts at $10,000, at just 8.5 lakh rupees, which you normally won't get for less than $1 million. So coming back to your question.
So right now, I mean, when you want to achieve adequate global diversification in your portfolio,
right.
And people, I mean, sometimes equated that I'm invested in the NASDAQ, ETF, or I have some fund which is dovetailing on the Dow. I don't know, is that enough?
No, that's not enough. That's what I was saying. US is not the world. So
yeah.
in 2021, if you remember, is when all these NASDAQ ETFs and fund of funds, etc., were launched in India.
Yes,
and not in hindsight, but at that time, I had come on your channel also and said that, 3 years NASDAQ has done brilliantly. Don't assume that this will last. And 2022, NASDAQ was about the worst performing index in the world. It went 40% down from the levels at which those ETFs were launched. And people came to me and said, should I sell now? I said, now that, don't compound a bad buy with a bad sell. Because a stock down 40% can still be a sell. But a major index down 40% is almost never a sell. And so, of course, it bounced back from there. But that's the whole problem with buying very narrow, focused indices or funds, and often it's just a layer of cost getting added at the India end.
So then which are the markets, or where else?
So you have to see that changes. Again, I can't say today that you buy this combination and that will last for 10 years. So that's why we do that. We have a fund and we have portfolio accounts which do that, because that changes, and we look at it every quarter. For example, this year, now we've gone underweight US, even though it's still large, but we've gone underweight US, we've increased Europe, in China we've been a little overweight from last year itself, India we are slightly overweight, so that would be, but that changes.
Okay, so that's global diversification, which is extremely important.
Right, so over time you should have 30-40% globally diversified.
Wow.
Yeah, so at least, I mean, logically it should be even higher, but because as it is, you are exposed to India, your career is here, your real estate is here. So, and people say if India is growing so well, why invest?
Why look at other equity markets?
Yes, but in the 90s, which were the highest growing economies, they were the Asian tigers.
Correct.
And then there was a crisis.
Correct.
And in 1 year, those markets fell between 50 and 90%. And that was a wake-up call for me, that if I was an Indonesian, my net worth would have been wiped out by 90%. So that was the sort of one of the triggers why we went global as far back as 1999. We were not just the first Indian, we were the first Asian firm to become a member of the London Stock Exchange, other than the Japanese. So because I realized that putting all your eggs in one basket is not a good idea.
It's not a good idea. Okay. On gold, I mean, you briefly mentioned a hedge against obviously currency risk, etc. But gold is an interesting debate right now. Yes, households probably have enough of it, and so there's one school of thought saying don't take overexposure, because from your grandmother to your mother, I mean, there's enough gold in the households. But the other school of thought is that gold is rarely sold for emotional reasons or whatever. So many people say that do you really want to include that traditional old jewelry as part of your gold allocation? Because it's not a sensibly well thought out, balanced financial way of investing in gold. What are your thoughts on it?
No, whether it was thought out or not, you hold it. So that you have that investment there. So, I mean, there's no reason to say that.
But you won't sell it, that's the point. That people say that it's just notional holding. You won't sell your grandmother's jewelry.
Indians do. I mean, every time gold and silver reaches a peak, Indians are out there selling.
Actually,
I mean, even now the jewelers are saying that buying is not happening in gold jewelry. So I think you should definitely add it in your asset allocation, and many times the grandmother's jewelry, the daughter or daughter-in-law no longer wants to wear in any case.
Could be. But on a steady state basis, obviously it will vary in different market conditions. But roughly speaking, I mean, do you give it 5%, 10% in a portfolio?
Yes, in that range. It should not be 25% of your portfolio, because gold is an extremely volatile asset. People think it is, it is some sort of a stable asset, but the dollar price of gold in 1980 was not breached till 2007. It took 27 years. In between, it came down more than 60%. 19 years later, it was down 60% from the 1980 level. So this is what people forget. It looks good, relatively okay in rupee terms, because it's really a rupee depreciation chart. In dollar terms, it has been more volatile than the S&P.
Wow. That's something to think about. But, finally coming down to some closing thoughts, Devina, and beyond, of course, we've discussed the asset allocation and some portfolio advice. I want to understand from you, when you've observed people over the years, what do maybe the rich do differently, which keeps their wealth growing? Or, should I put it the other way, what do perhaps some middle-income Indians also do differently to break through, to move to the affluent side? What have you observed, and what would you like to share with us at a more behavioral or maybe personal aspect?
So one thing is that don't start that so-and-so became so rich and what was the way they went. Because, for example, if you follow a very high-risk strategy where bulk of the people go bankrupt, but whoever survives, let us say, makes their money 10 times in a year. So if you start with 100 people, at the end of 5 years, there might be only one person left, but that person would have really made it out like a bandit. So you think that, but that's not good strategy.
Okay.
So never think like that. So as I said, do the basics right, that save sensibly, invest sensibly, start early, manage your risk, which means don't have too much. I mean, if you're talking of the stock market, don't be too concentrated in certain themes or certain sectors. Always have a stop loss on wherever you are investing yourself. So do all the sensible things. Don't think you will suddenly make it rich. I mean, somebody asked Rakesh Jhunjhunwala also that you made your money from trading, so why do you tell people not to trade? And he says that, I may be smoking, but I tell my children not to smoke. So because it's not a good idea, statistically speaking, to do that. So do the sensible, I mean, good investing can be boring. So it just doesn't sound very exciting that, do asset allocation and do global diversification, manage your risk and manage your mind. That's the, lot of what I've read in the last few years has been on how many biases and randomness we have as human decision makers, and why those are all very hardwired within us. So you have to
give an example of,
for example, this is loss aversion bias, that we hate to book losses. And a 1 lakh of a loss gives us more pain than 2 lakhs of profit. So don't try to make it up in the same stock or the same strategy. That's another thing which people end up doing, that when the stock comes back to my purchase price, I will get out, because the market has zero interest in your purchase price. So, you should be just agnostic where you make your money.
Okay. Manage your mind, and the money and the wealth will perhaps follow. All right, Devina, it's been a great conversation. Thank you so much for laying out some of the basic rules that we often tend to, overlook or forget. This is a good conversation. Thanks so much for joining us today.
Thank you, Surabhi. Pleasure.
All right.